Recording. How's everyone's week been? Good one. Cool. So today it's nice to be back with you all. I know last week we were running the Wealth Weekend, and the week before that I was running the challenge. So it's been a little bit of an interesting 2 weeks. Nice to be back. I know you sort of joined us in the other rooms, etc. So I wanted to talk. There's two topics that I wanted to go through, and I'm not sure if we'll have time today to go through both of them, or I'll keep the other topic for next week. So the two topics I wanted to go through was one was reviewing what Clem Sun took us through. So in terms of the conversation we had with Clem Santa, but I think I'm going to keep that for next week because I actually want to do a bit more preparation around it and go back and review my notes and everything else. But interesting enough, someone sent me an article this morning from The Economist, and I just am interested. Has anyone read the article? I did share it this morning on some of the WhatsApp groups, but has anyone read this article? If you have, just let me know in the chat box, yes or no. Okay, so Safina says only the key takeaways. No. Okay. Let's start, I think, with the key takeaways, because I think so that we don't overwhelm and confuse people. So let's start with the key takeaways. So I kind of read through it and I kind of put into my kind of thoughts on the key takeaways in terms of where we're at. So the first thing that's important in this article is that it talks about how the majority of people are on a 60-40 split, where 60% of their money is in equities and 40% is in bonds. And they then sort of they think they're diversified because they go and see their financial advisor and they've got some money in their local country and they've got some money overseas in other stock markets, etc. And the whole article is, are you diversified as you think? So the 5 key takeaways. The first one is true diversification is harder to achieve than it appears. While it is easier than ever to invest in a variety of assets, true diversification, what it's basically saying. So while it's easy to invest in lots of assets, true diversification is where you have different assets that offset each other's risk. So do you remember? I'm going to stop sharing each time just so you can kind of see me. But do you remember when I am presenting and I'm doing the challenge or something like that, and we talk about Ray Dalio, and we say that you need 15 quality assets that are not tied together? Do you remember that part? So remember how he's had a return of 21% for 40 years, and his secret formula is the fact that you need 15 quality assets but that are not tied together. And what I talk about in that presentation or in that course is where if you've got money in the London Stock Exchange and you've got money in the New York Stock Exchange and you've got money in the Sydney Stock Exchange, people say to themselves, oh, I'm diversified. But you're not at all, because if the New York Stock Exchange goes down, the London one's going to go down and the Sydney one goes down. And so let's go and get a little bit more complicated here. So if you look here, what it basically goes into, and it talks about, is firstly it talks about where diversification came from. I actually learned something. I didn't even know this. This Harry Markowitz got a Nobel Peace Prize in the 50s, but the fact that people have been doing it for centuries, and again, it's always interesting, but it's always the wealthiest people that have been doing it and investing around the world, etc., even in the 18th century and before. And then it goes on to talk about this, how people go and buy, but generally the classic portfolio is the 60-40, which is kind of firmly in the mainstream. By the way, it's interesting, this article said 60-40. I was under the impression it was 70-30, but it doesn't really matter. It doesn't change what they're trying to teach in any way. And then they go into it here, and they basically say, like, right, but there's one big catch, and it's building a portfolio has become quite difficult. And it starts to talk about how diversification gets the value of diversification is that the prices don't move. So the same as what Ray Dalio said is that they don't go at the same. They don't like they've got to go at different things. So a good example of this is that if you've got a house in London and you've got shares on the New York Stock Exchange, they're not that tied together. Like you could argue if the New York Stock Exchange crashes, it'll impact world sentiment and it probably have a short to medium term impact on your house in London. But realistically, often when the stock market crashes, people get scared and they do a flight to safety and they tend to actually go towards property. And so often it will maintain value, as an example. So you can kind of see that that's a good example of two assets that are not correlated or not tied together. And that really is what this first thing is trying to say, is that people think they're diversified, but they're actually not. Like they're in multiple assets. Now, I'll give you another example of this. So you know what a REIT is, a real estate investment trust. So you got a property fund or a REIT. Please just type if you've got any questions or if there's anything that I'm not explaining well. But effectively, a REIT, which is a real estate investment trust, or a property fund, so it buys lots of properties and it's on a stock market. So it's a listed instrument. And so people basically say, yeah, but Scott, I'm diversified. I've got money in shares. I'm in Google and Apple and whatever. And I've got my other money, it's in REITs, real estate investment trusts. I'm actually in property. And my question is, are they diversified? Yes or no? Safina says no. I can see she's wagging her head. Anyone else want to venture a guess? So interesting, if you go do the research, there's a higher than 70% correlation between stocks and kind of REITs and property funds. So what that means is that there's a more than 70% likeness, like they're more than 70% alike. So again, Ray Dalio says they need to be not tied together. Well, if something's more than 70% tied together, it's pretty tied together. Would you agree? I mean, most marriages aren't 70% tied together. I mean, let's be frank. You know what I mean? So they're pretty tied together. So people basically think to themselves, okay, well, they think they're diversified, but they're actually not. And I mean, this is why I love this article, because it's pretty much a massive foundational component of what I try and teach people, full stop. So the next thing is that if you go to point number 2, it starts to talk about the actual data. So global financial markets, the global financial integration has increased correlations. So it basically talks about how the markets used to move independently and how they become more synchronized. So let's just think about this logically. 100 years ago, when the New York Stock Exchange crashed in 1927, it probably took, I don't know, a month for the information to get to London. I'm making it up, I'm not quite sure, but it was probably a letter or a newspaper that traveled on a ship to England. I don't know, maybe they sent a telegraph. I need a history lesson here. Did we even have telegraphs then? I'm not sure. But the point is, it took time. Okay. And again, it talks here, and if you want to go really into kind of the exact maths, it talks about a correlation. So a correlation is how closely tied something is. And it basically goes into the fact that if you look down here, it's measured on a scale of -1, which means they're not tied together at all, and 1, like where they're completely tied together. And it basically goes on to say a pair of prices move in the opposite direction. So obviously, if they're completely opposite, they're -1. And if they're in lockstep with no diversification, they're a 1. Are you with me so far? Yes, everyone, you're with me so far? Yeah. By the way, I learned something from reading this article. I didn't know about this -1 thing. I'm going to use it going forward. But anyway, it's interesting. So in the 70s, the recon of globalization kind of started, and the average correlation between the stock markets for the developed markets was 0.37. So again, that's New York, London, Australia, whatever. By 2021, it was 0.75. So remember, 1 is where they're completely tied together, like what do they say here? Lock, stop, offering no diversification benefit. 0.75 is pretty close to 1. Would you agree? In emerging markets, it's gone from 0.05. So like what happens in South Africa, no one gives a shit, to like, 0.49. So the emerging markets they're not as tied together, but they've also dramatically increased in correlation. So if China goes down, India is probably going to go down, etc., in terms of that process. And basically what they're saying is the barriers separating them have come down the markets. Once they moved independently, now they kind of move together with the ebb and flow. So it goes on to say, it seems that geographical diversification has followed a trajectory warily familiar to financial historians, where few investors would manage the trick. It was a stellar idea, but once it became popular and available to the mass market, its dynamics were distorted and benefited and started to fade. A similar fate befell the Buffetton strategy, buying undervalued cigar butt stocks until automated screening made it easy to identify and hence vanish, basically make them disappear. In the case of diversification, once investors started spreading their capital across stock markets, they all began to resemble each other. Just by the way, type for me in the chat box if you're enjoying this, like this article, because I thought it was a really good article and a really good explanation in terms of this breakdown. So that was point number 2. Point number 3, I've kind of gone into now, but it's the sort of the benefits of investing across different regions have diminished across markets. They behave, basically because of the globalization, like everything just kind of moves in tandem. Okay. So if we go to all three of the first 3 points, have they made sense so far? Like in simple terms, all the stock markets are tied together with a high correlation. They're very integrated. It's very hard to diversify, and geographic integration virtually means nothing, even down to the emerging market stock markets as well. The fourth one I found very interesting because I didn't know this, but what's interesting is that, again, you've diversified. You've got 60% in equities and you've got 40% in bonds. Now, 10 years ago, or maybe longer, I don't know exactly the time frame, 20 years ago, whatever, stocks and bonds were like at the opposite end of the spectrum. Like when the stock market went down, the bond market went up. And when the bond market went down, the stock market went up. They were literally like two different pistons. And so like that's why the traditional kind of investing style is to put 60 or 70% in stocks and kind of 30 or 40% in safety and bonds. What's fascinating now, if you look at this, so you think you're diversified, but stock and bond correlation has increased. Traditionally, stocks and bonds balanced each other out. A minus 2.9% correlation in 2000. Oh, you see, I wasn't too wrong, 20 something years ago. But since 2022, the correlation has risen to 0.7. Remember, one is they're completely tied together. How interesting is that? And let's go into the article here. So it basically just talks about that here. There's some benefit to spreading your portfolio across different regions, asset classes, but given the gains have shrunk so much, it's a wonder that investors are chasing even more eccentric products. So what I find really interesting, just before I go to point 5, is who here properly understands a bond? Like what bonds are? Okay, Safina does. My simple explanation of a bond is that a government, a municipality, or a company provides a debt product, so they borrow money and they pay you interest. Would you agree with me, Safina? Am I roughly accurate? I'm not trying to sound like an expert, but are we in agreement with that? Okay. So if Safina was going to lend me money, whatever, I need to borrow $100, and she wants to lend me £100. I need £100. She's going to lend me £100. The most important thing that Safina should be asking is, does Scott have integrity? Can he pay me back my £100? What are the chances of getting my money back? What is my interest rate? But like the last thing should be the interest rates. Like how much, is Scott going to pay in interest? Because I could pay Safina 20% interest, but if I never pay her back and she loses the money, it's irrelevant. Okay, so this comes to Liz's point. Lending money to governments that are bankrupt, municipalities that are bankrupt. I'm not going to go into the companies as much, but most private investors don't even get access to massive company bonds anyway. Like you're basically lending money to your bankrupt mate. If you just think of it like that. And when you take the correlation that I just showed you into account, my gut feel is it'll be far better to be in at least companies that are growing, arguably growing, in a stock market environment than lending money to bankrupt people. I don't know, just my point. I'd love, if you disagree with me, challenge me. I'd love to be challenged on it. But I've never invested in bonds. Never. I don't have 1 cent. I've never invested 1 cent. It's never made sense to me. Why? I mean, I come from South Africa and I originally came from Zimbabwe. Like I learned a long time ago, you don't trust your government. It just, that makes no sense to me. Anyway, but anyway, don't worry, you can trust the American government because, everyone else does. Okay, which brings us on to point 5, which is that investors are seeking alternatives. As traditional diversification strategies weaken, investors are exploring alternative asset classes such as property, commodities, cryptocurrency, private assets to maintain portfolio resilience. Now, I know most of you, I'm preaching to the converted, but what I find fascinating is that the wealthiest people in the world, so that's people that own $30 million or more, so they have $30 million and more in net asset value. There's about 580,000 of them in the world. And over 70% of their portfolio is in alternative assets. So it's not in stocks and it's not in bonds. Over 70% of their portfolio. The vast majority have now moved more than 50% of their portfolio into alternatives. And can you now see why? Is it making sense if you reverse engineer this conversation? And so, I know I sound like a bloody broken record, but the point being is that, like, if the wealthy people are doing it, then surely we should be doing it. Like, they've got access to the best advisors, the best information, the best deals, the best partners, and everything in between. And what this final little thing says down at the bottom there with point number 5, which again, most of you are already heeding to, but most people are not. I mean, the vast majority, all your friends and everyone else are not doing this, is actually seeking out alternatives. Some people would say going and buying houses, you know how I feel about that. But I mean, a house is still an alternative to a stock and a bond. I just want to be clear. It's better. I still think it's a shit investment if you want my opinion, but it's better than a stock or a bond. So before I go any further, any questions, any thoughts on what I just shared? Glenn says, bloody hell, never thought of that before. Sorry to burst your bubble, Glenn. What happens when governments or municipalities go bankrupt, which is happening? So, yep, Liz, you beat me to it. Okay, I think that's a run. Okay. So then the question comes in, what do we do with it? And that was where, so I got challenged by my own team because they were like, look, Scott, we've got this presentation with Clem and you've been following Clem for, it's embarrassing, I don't know how long, but it would have been the late 2000s that I really started paying attention to what he was doing. So it's been at least 15, if not 20 years, but I'm not 100% sure. And but what I did was, it took me 5 or 6 years to follow him and really understand what he did. And that's when I started to build the models. And that's when he endorsed the book that came out in 2013. And the whole philosophy of it was, everyone gets this information. Everyone, I mean, virtually everyone in the world can get it. You can go online, you can watch videos, you can read it on the news. But most people have no idea what to do with it. And so what I've always tried to do in my life is, like, right, we've just got some very valuable information, but what are you actually going to do with it? Like, what's the point of just getting information if you don't do something with it? So I'll take you through it quickly. But basically, my team sat me down and they said, listen, we need to, let me just find it for you quickly. We need to help people. So again, if I go here, I'll just remind you quickly so that you've got it. By the way, I've only shared this with the mastermind members on the weekend. But usually you go and you present with Clem, And when I first started doing it, I mean, these are the diagrams from the book. I've got them in there on purpose. He gives you all these scenarios and his flags and his probabilities. I'm not going to go into that because I'm going to do that next week for you. I then built this model, which is the global property system, which takes all the fundamentals of investing and it gives you the risk index, and it takes the return and it gives the return index. And then ultimately, Clem actually helped me build out this modeling as to like where you should be investing based on risk and return. And that was where he was so impressed by the model that he agreed to endorse the book. And then the book 10 years later became Wealth Going Global. So what my team challenged me to do was they said, well, look, we're going to get information from Clem. How do we actually implement that information? And I thought about it and I thought, well, what do I do? So I don't want to sound arrogant here, but what I try and do is always go backwards and say, like, what is my methodology? What do I do? And how can I help other people copy what I do? So I basically figured that there were four things, the 40 wealth blueprint that we go through. And ultimately, it'll help you make smart decisions and build a diversified passive income. So the first one, you might want to write these four things down. If I was you, I probably would. But the first one is insights. So know what is happening globally. So whether you talk to Clem Santa, or you listen to him once a year or whatever. Sorry, I just need to get a water here. 2 seconds. All of you in England, it's very hot here in Africa. Sorry about that. Anyway, point number one is that it's all about insights. And so, you've got Clem stuff and, last week he went through the scenarios, the flags, the probabilities, and it gives you very good guidance about the future. At a mastermind level, we sit down with our family office every single month. We sit down with our family office. It only takes about 20 minutes. And what the family office does is they take us through three major things. They take us through the major markets and what is happening with the markets. Are they going up? Are they going down? What is driving them? How are they correlated? What are the key forces that are causing things to happen? Then they take us through the asset classes. What is going on with the different asset classes? How are they moving? And there's patterns and trends that you can figure out. And there's forces, interest rates going up causes REITs to go down, real estate investment trusts, as an example. Uncertainty makes people go more into value stocks. Excitement obviously puts people more in growth stocks, etc. So there's a lot of trends, and you don't have to guess. You can actually follow trends, and with insights, you can make far better decisions. I mean, for those of you that are on the mastermind on this call, are you still with me? Hello? Oh, you are still there. Okay. Yeah, sorry about that. I don't know what's happened to my electricity. It's all gone out. So I'm diversifying. I'm running off my cell phone and my laptop battery. Anyway, so where I was basically was, let me go back to sharing my screen. Evan, you saw this on the weekend, and in simple terms, you go through all the different assets. Where did I lose you guys exactly? I think I'd taken you through the different assets, etc., of what is actually about. Shona, I'll tell you about that. My little name. That if anyone's noticed, my name has changed on the Zoom meeting. The third thing that the family office takes us through every month, and every month it's different. But like, what are some of the key things you need to know? So this was literally last month. What's happening in the US, the Eurozone, the UK, Japan, China, Switzerland? What is happening with US unemployment? US unemployment's a massive driver, along with inflation, as to whether interest rates go up or down in terms of that process. And then you've got, this whole tariff trade war that Trump is, going after. And what does that actually mean? And what did it mean when he was in power last time in 2018? So it's just an example. There's been lots of other examples. When that bank went bankrupt in Switzerland, and then another one went bankrupt in America, it was like, what does that mean, etc. But can you see that the very first dimension is all about insights? So whether you're getting the insights from Clem Sunter, or whether you're part of the mastermind and you're getting the insights every month, or you're getting your insights yourself, whatever. But you've got to be able to get the insights to be able to make the right decisions. Are you with me so far? Just give me a thumbs up if I'm making sense. Yeah? Okay. The one thing I love about the mastermind is that before I had the mastermind, I had to go out and try to read all the different stuff and Motley Fool and, you name it. Like, I'd try to go find all the information myself. What I love about the family office is they get paid by the wealthiest people in the world. They've got whole teams going and looking at all this data, synthesizing the data, and then turning it into a short report and or talk that they do once a month. And I personally get access to that now, which it makes my life, I call it a TED talk, but it's so nice because I don't have to worry about all that other stuff. And even when stuff's going down, like whatever, Trump's doing tariff wars, I'm like, don't worry, I'll find out when I have my monthly update. The second thing is the blueprint. So use a proven wealth building blueprint. So there's not only one blueprint out there, but rather than sort of guessing, it's far better to use a blueprint that has been proven to work. So I already explained earlier some of the blueprints I've used, to start off with. But I think the key thing, and again, I'm just really repeating because most of you would have seen this before, but one of the blueprints we use, which was based on Ray Dalio, is that to diversify, you've got to diversify across countries, currencies, assets, partners, and time. And it's all about the passive income, which sits in the middle. So that's one blueprint. The second blueprint is this one that we created with the family office, where, again, most people out there, when they go and see their financial advisor, they're literally getting one step. Their financial advisor listens to them and helps them invest. And they generally put them in a box. Are you low risk? Are you medium risk? Are you high risk? How old are you? Boom. Invest your money. And I don't want to be rude, but most often it's, put in a product where they earn the highest commission. When you look at the family office, they actually look at all 9 steps. So we watched them for 10 years. We were been part of the mastermind for 2.5 years, so we're a lot closer. And we really analyzed, like, what do they actually do for their wealthiest clients to create generational wealth? And there were 9 steps, and I'm not going to go into them, but this is an example of a framework. And again, I would screenshot this if I was you, because if you're not part of the mastermind, you should be asking your financial advisor and saying, right, what are you doing about all of these different steps in terms of this process? The next one, dimension 3, is action. So take strategic steps, not emotional ones. And this one for me is equally as important. And you can see here on the right-hand side, where at the mastermind level, we take people through a 9-step process. I just explained the 9-step process. So there's a strategic step-by-step process. And if by any chance you get stuck, you just go back a step. In the worst case, you even go full circle back to step number 1. And by the way, on an annual basis, you probably should be going through the 9 steps. But the problem is most people aren't. They don't have a process. And so they take action. The stock market drops. They shit themselves. They sell their shares. The stock market goes up. Crypto goes up. Their mate goes, hey, you should be in Bitcoin right now. They go, that's a great idea. They go buy Bitcoin. It's like literally the top of the market, and then it falls again. Like, there's no strategic steps. I think hopefully this is kind of common sense, but ironically, common sense is not very common. Have you ever heard that before? Like, most people know this stuff, but actually don't do it. And then the last one, just to kind of show 2 steps here. One was the Enneagram and wealth. I don't know, for those of you who saw the Wealth Weekend, I love, there's a video that Garth did where he spoke about how the world is changing now. And in the past, you would just kind of invest based on, the box, basically, like, are you low risk, medium risk, or high risk? And then Garth spoke about how we can have human-centric investments. So we can have investments tailored to the human, to the individual needs, to the individual challenges and life, and ultimately it's what is the lifestyle you're wanting, and then you build a portfolio around that, and that then tied into this. And we basically spent the entire wealth weekend going through this, because portfolio construction, which equals 85% of your total return at 65, comes down to three things: your individual circumstances, your Enneagram profile, and your asset liability model. And the whole philosophy here is that you've got to have all three legs of this table to make this portfolio construction work. Fascinating principle. But this is an example of having strategic steps. And then ultimately, it's about building out the entire plan, and then you're working the plan. I always have people come to me and they say, hey, Scott, is this a good asset or is this a good asset? And I go, well, it depends. What's your plan? Because ultimately, the assets should just be vehicles along the plan. And you shouldn't be going, is crypto good or bad, or is Bitcoin good or bad, or is this house good or bad? It depends if it's in your plan. And then finally, the last one is community. And it's about surrounding yourself with experts and other investors. And I know this one sounds so common sense, but I want to replay this video. I think most of you have seen it before, but I just want to repeat for you why this is so important.
Now, this is extremely predictable. There's tons of research around it. Humans change.
Sorry, I just want to share with audio.
Now, this is extremely predictable. There's tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case.
Wow.
So I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new, folks. They're not new at all. People have been doing this for thousands of years. And when you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
And, I summarized that, 5 times faster, a collection of people, all committed, all driven, so want to make the right changes, which is a group like the one we're in now, and a leader who's willing to get in the trenches with them. All of a sudden you get real rapid. But ultimately that comes back to the community. And I'm, again, I was so privileged to be part of the Wealth Weekend over, this time last week. And it was just phenomenal, the conversations. And it's not only the ones coming from the presenter's mouth, but it's the conversations from the collective group and the collective wisdom that is taking place, which is why the fourth dimension is about being in the right community. And so if you want to bring that all together as a framework, step one is ultimately you understand the scenario planning. Step two is that you apply the 4D wealth blueprint. So you're getting those insights. So again, remember that, like Clem Sunter will tell you, you got this flag, this probability, etc. So it's like a long-term view. Then obviously you're getting the monthly sort of insights, and you need to know what's going on and happening globally. You need a blueprint, which is a proven wealth building blueprint. You need to take action in strategic steps, not emotional ones, and you need community. You need to surround yourself with experts and other investors. And then finally, step 3 is take action and secure your future. And so why this is relevant, and for Evan, I saw Evan joined, Evan was there at the weekend, so he would have seen this before. But what I was doing, for some of you that arrived late, was I was just tying this together with this article that I summarized for you. So it's this article here, which was by The Economist on diversification, and why there's such a high correlation between the different stock markets, but also between the stock market and the bond market. And then it goes on to say investors are seeking alternatives. And I just wanted to provide people with a way to be able to do that. Whether you want to work with us or not is a separate conversation. But I just wanted to work with people to kind of show them how to do that and to give them a simple framework. So hopefully, screenshot this if you want. There's your framework, as to how you can predict the future and build the wealth with confidence. And basically I hope it's not complicated. So do me a favor, give me some feedback, please, if I stop sharing. Does it make sense? I would love some feedback. We have tried to tie things together. So we've got let's call it the Economist kind of article. and the challenges with the traditional diversification model. And then, I'm a big believer in life. There's no point in talking about a problem. It's like, what's the problem? And then more importantly, what's the solution? Okay, so Thomas said, how soon will the recording be available? Missed the first 30 minutes. Thomas, it's only for people who are live. We're going to delete the recording. I'll figure it out and share it. So it's Friday afternoon. It's time to start having some fun. Liz said, yes, it makes sense. Makes me realize there's still a step one that I have not done and was supposed to do last November. So perfect. Evan, thank you. Very interesting, informative. Shona, thank you. Millicent, yes, makes sense. Makes lots of sense. Okay, cool. Okay, so cool. Well, has anyone got any questions? Because we're only 36 minutes in. Alistair says a clear blueprint. Yeah, Alistair, I was quite chuffed with it actually. I know I now sound arrogant, but I'm allowed to. We talk every Friday. I was like, when the team made me go and do the homework, and I sat down and I did it all, I put it all in. And when after I looked at it, I was like, wow, that's actually quite good, because it's simple. It's simple. Like, so I'm often guilty of like over like going into too much detail and people get confused. Like the global property system. Like, go find the legal, from here, and the economic reviews from here, and the property discounts from here, and like people like, Scott, what the hell are you talking about? So at least this one's a bit easier.
Scott, I agree with you. I did the same thing, just with an overall plan. Your diversification got me thinking to just really create a big spreadsheet of everything. And once you've done that properly, man, it's very, very motivating to continue. So yes, I can feel your feelings.
Well, it's interesting. If I understand what you're saying, Alistair, I'm not 100% sure I do, but when people sit down with the family office, I think most people are quite surprised by how much overlap they've got. So they think they're diversified, but actually they've got a lot more overlap than they expect. And then they've also got often fees on top of fees. So they've got this fund that's actually investing in, like, they think they're separate, but they're actually in this fund already. And then there's a feeder fee and this fee and an asset management fee. And I get this over and over again. People come and go, wow, like, I didn't realize how badly correlated I was. I'm sorry, it's a fancy word, but tied together. And then on top of that, how much duplication I had in the fee space. So it's often, a little bit scary for everyone. The correlation is a bit scary. So private equity becomes so much more important. Evan, that's exactly the point. That's why private equity has become such an important thing. And if you remember this slide, I'm bouncing around, but let me just go find it for you quickly. Good thing for you guys, I know where to find the slides. This one here. So if you remember this one, that's why this one's so powerful, because again, if you take the 30-70, again, the economist said 60-40. But these people are basically in the highest risk category. So this from left to right is low risk, high risk. They're in the highest risk category. And then this is return, low risk, high return. They're in the highest risk with lowest return. And by just putting 20% private equity into their portfolio, they move into the lowest risk, highest return. And that's over 25 years, according to all these fancy things, Bloomberg and a whole bunch of other things. And to some extent, when Evan says, it's a bit scary, that's the point. That's why people are doing private equity. And the other thing that I find interesting is that traditionally people couldn't do private equity. I mean, just by the way, why don't financial advisors advise you on private equity? Come on, let's have some fun. Anyone want to type in the chat box? You can talk. I don't care. Anyone want to say why? Why don't financial advisors tell you to invest in private equity?
Because they can't participate in the fee structure that they sort of get fed by these bigger organizations.
Well done. That's exactly it. Shona said not enough commission. Lorata said no commission. They don't know how to make money out of it. Yes, those jokes are all being trained well. I'm impressed. That's exactly it. Because in a listed environment, it all goes through the trading platforms. They all get their commission up front and they get their ongoing trail. Whereas if they go into private equity, whatever, I don't know, you want to buy my house here. And they're like, go and do that. And they're like, oh, shit, now I've just lost, whatever, $100,000 out of my managed portfolio, my assets, like all of that stuff. Boom. So it's 100%, in my opinion, and I'm conspiracy theory here, but it's 100%. No, sorry, it's probably 9%. It's 80 or 90% because they can't figure out how to monetize it. And it's 10 or 20% because there's actually no way to do it easily. And so they just avoid it completely. And that's why it's only ever been the bastions of the very wealthy. I agree with you, Mike. In the UK, by the way, the regulators don't like it anywhere. Mike, I know how much you like your government. We can go into a whole thing here. Do you know that in America in 2009, 2010, 10 million Americans, 10 million middle-class Americans lost their houses? Okay. So they could go buy houses and they could get mortgages, and 10 million Americans went bankrupt. That's unregulated, no problem. Anyone can buy houses. But can you go into private equity? Nope. You've got to be a accredited investor. Different countries have different names. Can you do structured notes? Nope, you can't do that. You have to be an accredited investor. So you're not allowed to do that. But you can go to Vegas and put $1 million on red or black. No problem. It's like, just listen to what I'm saying. Like, it is so illogical. Anyway. Yeah, Mike's saying in the UK, you got to have 250K net worth, not your home, and not your pension. Yeah, so it's the same everywhere, Mike. It's the same. And that's where, by the way, that's why crowdfunding came in. So in 2013, when America brought in the SEC and then the FS, I know it changed all the time, but at the time it was the FCA in England, was super proactive. Actually, England's got one of the best regulations in the world in the crowdfunding space, and it's done wonders to build the businesses in England, the SMEs, small to medium enterprise businesses. So yeah, crowdfunding is on the junior end of private equity. Have you all seen that curve, the S curve? Do you know how the different stages work between friends and family, venture capital, and then private equity? Have you seen that before? Anyone want to? By the way, Thomas, yes, the regulators are in cahoots. I'm sorry, but this is I'm going to have to delete this recording, otherwise I'm going to get shot. But no, on a serious note, who pays the regulator? Does anyone know who pays the regulator? Anyone? Safina says the government. Nope, not the government. It's all the big companies. They all have to pay a fee every year, depending on how big they are on their turnover. They pay the regulator. The regulator's salaries are paid by the financial industry. By the way, if you want to watch a very good movie, brilliant movie, I've never heard of it before until I flew home from England now when I was on my buyer's trip. It's called Bank of Dave. Okay. And it is an amazing movie. It's a true story. I've now watched both of them, Bank of Dave and Bank of Dave 2. And they've never opened a bank in England in 150 years. This is exactly what I'm talking about. And so this guy is a fairly middle-class, wealthy businessman. He says, I want to open a bank. And they were like, you can't. He was like, why not? And they had not opened a bank in 150 years. Now, who pays the regulators for the banks? The banks. And in 150 years, no one had broken through that. Amazing movie. It literally sums up everything I just tried to say. And it's a true story. So just in case anyone thinks I'm making it up. Dave, brilliant, bro. Yeah, what a cool dude. Eh? Shit, I'd love to meet that guy. I've actually subsequently gone and watched a whole bunch of YouTube videos. He's a real inspiration. For someone that's trying to empower everyone to invest like the top 1% and is constantly having challenges with regulation and compliance and whatever, because, the rules are built for the old system. He gives me a huge amount of inspiration of what's possible. So, yeah. But, yeah, I would highly recommend that. Do you want me to try find that quick slide on the S-curve? Is anyone interested? Okay, so let me find it for you quickly. I've got it here, I think. Oh, shit. Yeah, there it is. Okay, so I don't remember where I learned this. And I don't even remember where I got this, like where I got the information to build the slide. But in simple terms, what you got is you've got the company value here on the left, and you've got time at the bottom. So they always talk about the proverbial S curve, where it goes slowly in the beginning, and then it kind of grows really quickly, and then it kind of flattens out. So that's that's arguably perfection. Everyone's always looking for this S curve. So in the beginning, you got startup, then you got kind of scaling, and then you got mature, and then you got listed. So listed being on the stock market. So what you got down the bottom here is you got the founder. So kind of often what happens when you start a business, I did this with Wealth Migrate. I put in with my co-founder. I had another company called International Property Solutions, and it was a good little business, a nice profitable business. So I put in the funding to start Wealth Migrate, and then we got seed investors, and they often are called, to some extent, they can be friends, fools, and family. They call them the three Fs. But generally, it's people who are close. They know, they might be part of the company. They might be like clients in the company, et cetera, whatever. But it tends to be that. Then you go to kind of venture investors. So this might be crowdfunding. It might be angel investing. It might even be venture capital. But ultimately, it's once you've already got a proven model. So something like Wealth Migrate, you already got a proven model. It's been investing for a while. It's got a track record. It's making money. They always talk about pre-revenue, post-revenue. But once you've kind of got a model that's working, and you've got product market fit, which basically means that people want your product, then it's about the capital to scale the business and to grow the business. And then kind of once it's really scaled, it goes into maturity. And at this point is where the private equity often gets involved, the large scale private equity. And that's where they take it to the final level, which is where it gets listed in an IPO. And that's where all the corporate money comes in. So that's the famous S curve that hopefully explains a little bit more. Boom, get him on a session. Shit, that's a good idea, Alistair. Yes, now you got me thinking how to do that. That'll be brilliant. Anyone in contact with Dave? I'd love to do a session with him. Dave is on Twitter if you want to contact him. Okay. I'll try to figure that one out. All the rules and regulations today were created only by a handful of super wealthy in the last 100, 200, and of those have roots in ancient empires. So to some extent, yes, Thomas, but if we get less kind of conspiracy theory and we get even more direct, my understanding is that the SEC laws and they sort of drive all the world's kind of regulatory compliance came into place in 1933. So what most people do remember is that we had that big crash in 1927. So was it 1927? 1929. Sorry, 1929. And they had the Roaring Twenties, and basically everyone was being sold. The mommy, the granny, everyone was like, put your money in. You went to the hairdresser, and they were the best stock pickers on the street, and all of this stuff. And that everything was growing, and everyone thought it could never fall down. Sounds a bit like today, doesn't it? And then 1929 happened, and everyone lost their money, and the world went into depression. And so people were like, right, we need to bring in rules. No one can talk to the grannies. No one can talk to the mommies. No, the hairdresser's not allowed to invest. Blah 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 blah. And that was 1933. And what's scary is that was 92 years ago, and the rules haven't changed. So that's less of a conspiracy theory, and that's a fact. Literally, it's a fact. They have not been that when the crowdfunding rules came in 2013, it was the first movement towards changing that stuff. Mike said in the UK, an advisor won't be criticized by the FSA of his client based it on the 40-60 or 60-40 or 80-20. It's so interesting what you say there, Mike. Sorry, you guys are taking me down tangents here, but in a good way. Elon Musk said that. He said, if you're a regulator and your job is to, regulate something, and you come along and you want to take a rocket and you want to do it differently, you want to go into space and, whatever, and you're the regulator and you say no, you keep your job. That's your job. Your job's to keep the rules as they are. If you say yes, and the rocket blows up and people die, you get fired. Why would you ever say yes? And if it works, you get a pat on the back. Well done, but nothing happens. You probably don't even get a job promotion. So like the first time I heard that was from Elon Musk. It was like, it made so much sense to me. I was like, so they were completely incentivized to not do anything, which is exactly what Mike's saying. If I'm a financial advisor and I'll tell you guys to put 40, 60, whatever into stocks and bonds, because that's the traditional thing, and it goes wrong, the entire market crashes, it goes to naught. Everyone goes, well, that's what we were supposed to do. Whereas if you go and put your money into property or anything like that, then, it'd be terrible. Gold broke 3,000 today. I didn't see that, so thank you. Once people in power will have responsibility in the system, they will be afraid of change. Exactly. So that sort of sums up what I was just trying to say. In November, December 21, it was obvious that interest rates would rise, price of bonds would fall, and almost all the advisors put the low-risk clients in high percentage bonds, and people close to retirement lost 40% in 1 year. And Mike, I'll tell you a funny story. I probably shouldn't be laughing when I say this, but my mother in 2001, so she was given a bit of inheritance, and so her great uncle died or something. So her financial advisor said, listen, whatever you do, you got to take your money out of South Africa and you got to move it into pounds. So she did that. So she moved money. Oh, by the way, if you don't know, the rand to the pound, it had fallen really badly in like 2000. It was sitting at something ridiculous, like 22 rand to the pound. So she took it out when the currency was very expensive, and then she put it in the London stock market, the FTSE or whatever. And like the FTSE for the 2000s had terrible growth. It was like 3% or something, like per year for 10 years. And after 10 years, the financial advisor goes, no, actually, that was a bad idea. Okay. I tell you what, why don't you bring your money back to South Africa? The rand had like half. Now the rand was like really strong again. And so they lost money again on the currency. And then they put the money into the JSE for 10 years, the Johannesburg Stock Exchange. And then that went flat for like 10 years. And the irony is they opposite. The Johannesburg Stock Exchange in those 10 years, the first 10 years did really well. And the London Stock Exchange in the last 10 years did really well. And this guy just kept playing. And every time he played, my mother lost money in fees and transactions and everything in between. Anyway. Watched a docu that explained the crash was orchestrated and planned to capture wealth of the 20s, since everyone bought bogus assets and sold them. Yeah, I as I said, I don't necessarily aspire to, let's call them conspiracy theories. I have no doubt that there's forces beyond my knowledge, and none of us are at the playing field. I have no doubt about that. But I tend to rather go back to, like, let's call it the facts we do know, like 1933, the rules were put in place. And to some extent, you can understand why. I mean, watch The Wolf of Wall Street and you know why you've got to have regulations. I just want to be clear, like there's definitely a place for rules. But I think what's important is just that the rules need to stay up to date with time. I'll give you another thing. We were the first property platform, to my knowledge, in the world on the blockchain in 2016. Literally us, Migrate. We launched a property token in 2017. So my logic was, you buy this house, imagine it's like Bitcoin, but underpinned by property. It's like, for me, it's common sense. Like, this is where the world's going, guarantee it. And I thought it would happen quite quickly. But the regulators to this day have not regulated a security token. So you got a utility token, you got a security token. I don't want to kind of confuse people, but to this day it's not regulated, which means no mainstream's in it. And the banks actually turned around to us. So we with Lemonway, the digital wallet provider, and Lemonway wanted to allow crypto. The French regulator, which is the European regulator, wanted to allow crypto, and the banks wouldn't allow it. So they shut our crypto thing down. And that's probably enough for today, if I haven't confused the shit out of you already. Any questions, any thoughts, anything that I can help with? Something I just wanted to share with you quickly. You'll notice that I have updated the calendar. So I've done it both in Wealth Hackers and in the Mastermind Private Wealth Global. And the reason being is that on Wednesdays, when Alex does his session, it's all about accountability. So this is all around the passive income challenge, and it's helping people get their wallets funded, how to use the platform, how to invest, whatever, KYC, etc. And then every Friday, we're calling it wealth strategy. And the idea is that I will basically bring up what I've learned for the week, what I see. Next week I want to do Clem Santa. But yeah, it's not. There's no prescriptive part to it. But I like the word strategy because it's like it's sort of bigger than like the technical details of using the platform. We will record it for whoever asked earlier, but I'm not sure yet where we're going to put it. So I need to ask Shane where we're going to put them. But there's no like I'll try and bring a theme. But I want to be very clear. The whole intention is also the Q&A. Like so, any questions anyone's got, then we're going to do it. And then I'm also trying to finalize with Paolo, my CFO. I want to do at least every 2 weeks. I want to do a deals update where we can actually talk about deals, and if it's like, hey, what's happening with this or whatever, and he can actually be there alongside and actually answer questions. Don't hold me to every 2 weeks. Worst case would be every month, like as an example, but actually have a monthly kind of deal focused one as well. Cool, Liz, no problem. I'm glad you're enjoying them. And two other things. Watch your emails. We're going to do a webinar next week with Simon Zutsky on Thursday evening, which is quite exciting. And then the week after that, we are doing one, actually both England, by the way. We're doing one with the founder of CarryFit. So the people that have invested in CarryFit, so that you can come and meet him. And those that haven't invested, there's going to be a second tranche. But like for me, it's always, I can talk about CarryFit, and even Callio can talk about CarryFit, but none of us are ever going to do it justice compared to the founder who's built it, if that makes sense. Yeah. Don't know, watch the space in terms of that process. Cool. Hi, Scott. Judy. Hi, Scott. Can you please show me the videos to fund the wallets? So, Judy, you go to the passive income challenge and you go to how to fund my wallet. Help you? Judy, I don't think it's, let me just check. I don't think it's in Wealth Hackers. It's in the Wealth University. Let me just see here quickly. Yeah, no, it's not. So Wealth Hackers is the more advanced courses. That one's free. It's free for you. It's in the Wealth University. So just sign up. If you're already on Zoom, you can literally just search for Wealth University and sign up, and then go to the classroom, and you've got the passive income challenge, and it's basically got the 4 steps, and there's the how to fund your wallet. Cool. Okay. Well,
Hi, Scott. Sorry to be a pain about this. Sorry, I'm just all over the place. I'm kind of starting and I'm in between. So should I maybe leave this for Wednesday? It seems like I'm below the pay grade at this level.
No. So look, Wednesday is definitely the place to help you with, Judy. But what I'm going to do is I'm just going to put the link here in the chat box. Just click on the link. It'll literally take you straight there. But yes, the intention is that on a Wednesday, this is exactly what Alex can help you with, where it can be more technical. How do I fund my wallet? How do I do KYC? That stuff. So we very consciously are doing the two separately, because someone like Frankie, I'm just picking on you, Frankie, the first person I can see, she has been investing for 4 years. She knows how the platform works. And so she wants to come to this session to talk strategy. And someone like Judy wants to know how to fund her wallet. And maybe she wants strategy as well, but that's her choice. You know what I mean? So in terms of that process.
Great stuff. Thanks, Scott.
No worries. Awesome. Okay, everyone. Have a wonderful weekend, and we will see you next Friday. Cheers.